So hopefully for this next part, you've already printed out the accounting equation sheet. If you did, it should look a lot like this. We're going to go through slides 10 through, starting at slide 10, and go through the different transactions. Remember, we defined transactions as anything that involved a financial piece. So we're going to look, starting at slide 10, and see how the accounting equation is affected. So the very first transaction is Smart Touch Learning's a business, and they are starting their business, and for that they have somebody who's willing to invest $30,000 into their business. So basically we're getting cash as Smart Touch, and we're going to give away common stock. So let's get that recorded. So the first thing we're going to do is record cash up here. Cash is an asset because it's a resource that you will be using for the business. I'm going to put transaction 1 there, and I'm going to go $30,000. For that $30,000, I'm going to go over here, and it's equity. I'm giving up capital, common stock, $30,000. That's it for the transaction. Put an equal sign, and as you can see, assets equal liabilities plus equity. Next transaction. So the next transaction shows that while the accounting equation doesn't change, you always have assets equals liabilities plus equity, you don't always have to have something happen on both sides of the equation. In this case, Smart Touch is going to purchase land. Land is an asset because it's a resource that they'll be using later. So everything's staying on the asset side, but as you'll see, the accounting equation still works. So we're going to start transaction 2. We're going to use $20,000, so that's going down, to purchase land. That's going up $20,000. Let's write our balance as it stands now. Cash is $10,000 plus $20,000 for land. That's going to equal 0 on our liability side, plus $30,000 for equity. So we're right back to $30,000 equals $30,000. Our next transaction, transaction 3, involves the purchase of office supplies. Office supplies are an asset. Again, there's that resource again that we're going to use for benefit the business. So we're going to start a new category called office supplies. And the amount is $500. So we're going to say plus $500. Now this time we did not pay cash. We used accounts payable. Accounts payable is something that is due in the future. This happens to be due in 30 days. So 30 days due, it's something that we owe a creditor, that becomes a liability. Most liabilities have the word payable in their name. So we have accounts payable, and that's going to be for $500. So let's take that balance again, below 3. I still have $10,000 in cash, $20,000 in land. I now have $500 in office supplies. Let's see if we equal. $500 in accounts payable, plus the $30,000 in common stocks. So now I have $30,500 on both sides. The accounting equation is still working. All right, transaction number 4, we're doing some work. Smart Touch is in the service industry, so they're selling service. And the service that they are selling is generating $5,000 in revenue that is being paid in cash. Okay? So they're receiving cash. It's $5,500 in cash. So we're going to go number 4. Cash is going up $5,500. There's no other asset affected. Cash is the only thing that's being affected. So we're going to move over to this side, and we see on our equity column we have revenues. So our revenues are going up $5,500. Let's see if we balance. We now have $15,500 in cash, $20,000 in land, $500 in office supplies. On this side, we have $500 in office supplies, plus the $30,000 in common stock, plus the $5,500 in revenues. And we are still balancing. Our assets equal liabilities plus equity. This time around, SmartTouch is earning more revenue for transaction 5, but if instead of the customer paying cash, they're paying us in an accounts receivable. So we are becoming a creditor. It's a receivable to us. It's an asset because it's money that we'll eventually get for work that we performed today. So we're going to start, since we already know revenues, let's go there and we're going to add $3,000 on the revenue side. And over here, we're going to start a new account called Accounts Receivable and put plus $3,000 there. This is transaction number 5, so make sure you plug that in. And let's see if we're still balanced. So our balance is $15,500 in cash plus $20,000 in land plus $500 for office supplies plus $3,000 for accounts receivable. We still have the $500 debt plus the $30,000 in common stock. Now we have $8,500 in revenue. If you added up both sides, you would still be balanced, so the accounting equation is working. All right. Transaction number 6 is dealing with paying different expenses. Okay. We have rent expense and salary expense. Okay. So we're going to go up here because they affect equity. And right above this expenses, I'm going to write the word rent. And over next to it, I'm going to write the word salaries expense. Okay. This is transaction number 6. And how did we pay these expenses? We used cash. So the total cash was $3,200. So that's going down $3,200. And on this side, I'm going to subtract out the $2,000 for rent and $1,200 for salaries. And then I'm going to balance. My cash is now $12,300. So my land hasn't changed. My office supplies haven't changed. And my accounts receivable hasn't changed. On this side, I have the $500 in accounts payable, $30,000 for common stock, plus $8,500 for the revenues, minus the $2,000, minus the $1,200. So we are still balanced. Okay? And transaction number 7, SmartTouch is paying $300 on that liability, the accounts payable. So we're paying part of it. We're not paying the whole amount. So we're going to go back to number 7 over here. We're using cash, so we're going to take our cash and decrease that by $300. And then our liability is going to decrease by $300. We'll get our balance together. It gives us $12,000 in cash, $20,000 in land, $500 in office supplies. That doesn't change. We still purchase the office supplies, so that balance stays to $500. We're just now paying on the debt. Nothing else is affected. Even though we're using cash to pay for the purchase of the office supplies, we already took that because we counted it as a debt. So we're going to have 3,000 for the accounts receivable. Our liabilities goes down to 200. 30,000 for the common stock. 8,500 for revenues. And we have our rent of 2,000 and our salaries of 1,200 decreasing. Okay. All right. Here we have another transaction for transaction 8 that's only happening on the asset side of the equation, but things would still balance out. Okay. So for transaction 8, what's happening? Our customer that we gave the receivable to is paying $2,000 of it. So we're getting $2,000. So our cash is going to go up by $2,000. And now what they owe us is decreasing $2,000. Let's get our balance together. Cash is now $14,000. $20,000 for the land. $500 for office supplies. $1,000 is now owed. Nope, we forgot our equal sign up there. So we'll put it in when we fill in down here. Still have $200 in the liability. $30,000 here. Plus $8,500 for receivable for the revenues. Minus the $2,000 for the rent. And minus $1,200 for the expenses. All right, our last transaction for this period is transaction number 9. And since we made some money this month, which we'll get into more detail later on, we're going to pay our investor, Sheena Bright, $5,000. This account dividends is essentially payments to owners on profit. So that decreases the equity value because we're actually paying it out. So we're going to go minus 5,000 down here in dividends. Okay. And to do that, we're going to pay cash. We're going to use cash, so that decreases too. So our balance now is 9,000 in cash. Plus the 20,000 in land, plus the 500 in office supplies, plus the 1,000 that customer still owes us. So if you add all those up, you should have 1,000, 9,000, that's 10,000, 30,000, 30,500. Okay, on this side, we have the 200 liability. We have the $30,000 we paid. The customer paid us for, not the customer, the owner paid us to buy stock. Minus the $5,000 we paid back to the owner as dividends. Plus the $8,500 we generated in revenue. Minus the $2,000 we paid for rent. Minus the $1,200 we paid in salaries. If you did all the additions and the subtractions, we should have $30,500. And therefore, our accounting equation, assets equals liabilities and equity, balanced. So hopefully this helped explain things. Take a look at it a few times, and if you have any questions, let me know.